see. Webinar is now streaming live on Facebook. Andy Fenton, welcome to Wine and Wisdom at 5 o'clock on a Friday. Now, Andy, tell us what's going on there right now. This is not Wine and Wisdom without wine, and you've got something that is not alcoholic.
I'm seriously thinking about chucking a little bit of vodka in there or something.
What is going on, Andy? Tell us. Listen, everybody listening in, Andy's on a juice cleanse. His timing couldn't be worse for Wine and Wisdom, but I'm supporting you, brother. I'm supporting you. What's going on?
Right, I don't know who thought of these cleanses. This is self-induced punishment, and I'm going to say, well, I guess one of the benefits that is going to come of this is that water tasted sweet the other night because of some of the juices that we've drank. And for those of you who haven't done a juice cleanse, this is the first time I've ever done one. So day 2 into it, I couldn't string a conversation together. I couldn't, and there you go. And it's still happening. I couldn't string a sentence together. And mate, supposedly it's all good for you, but I'm going to cheers with my Highline orange, ginger, carrot, turmeric, matcha green tea. And this is the best one of the lot, I reckon. So, mate,
well, there you go, mate. Ching ching to you. Now I'm having a bit of a challenge on seeing everyone that's online, but it looks like there's a fair few of you guys joining us tonight. So welcome, gang. For those who are joining us for the first time or watching the replay, Andy Fenton, Jason Witten, we get together on a Friday and we have a bit of a yarn about what's gone on in the week from our respective fields of expertise and experience. Andy, 20 years in the world of financial planning, banking and finance. And for myself, 20 years plus in the world of real estate investing. And we have a bit of a chat. Often it's kind of like cats and dogs, share guys and property guys can't be friends. Cats and dogs can't be friends, but I don't know. That's probably not a good analogy right now. Who's the cat, who's the dog? Anyway. But so welcome for everyone. Hey, listen, we want to chuck it out early this week. If you've got questions you want Andy and I to have a chat about, put them in the chat and we'll get to them a bit earlier this week. There was a bunch of you guys who asked some questions last time. We didn't get around to them, so we apologize to that. But this week, we want to try and make sure we get onto those early with you guys. We've got a little bit of stuff we want to talk about. We're going to call this segment In the News. And later in the hour today, we're going to talk about some things. We're going to talk about private to public arbitrage, what that means. And I want to talk about the fractional banking system in Australia and reference the world and how lending works, how money works in our system, because I think that's kind of cool subject. And by the end of tonight, a couple of glasses of wine, we could wax lyrical about that one all day long. Andy. So it is not financial advice. Well, actually, yeah, you're going to be as well. You're going to be right on it. Well, maybe not anyway. But mate, in the news over in my neck of the woods, I'll sort of kick it off as we go. But I did this one earlier today with my Facebook Live. I usually do a Facebook Live in the mornings with we call it a coffee and a chat. With my positive crew, but really interesting thing, which is counter to all the media, which is what I've been saying, what you and I have been saying for a long time, Andy. The media has no interest in reporting interesting, accurate information. They're only interested in getting eyeballs on their stuff. But really, gang, the national vacancy rates in the real estate game across the whole country fell in the last 12 months from 2.3% across the whole country to 2.1%. Wow. The vacancy rates have fallen, and this is where I talk about it all the time. Listening to the right providers of good information and data is super important. I went into it in depth this morning, Andy, on my coffee and a chat. But really, at the end of the day, it's a tale of a number of different cities. When you think about which ones have increased in having properties vacant. And we dive in and have a quick look at that, where we might say, all right, well, Melbourne's had an increase in vacancy, and slightly Sydney has had an increase in vacancy. And you think, well, Melbourne's having a tough time, but really it's actually the majority of those vacancy increases, close to 70% of those vacancy increases are in the CBD postcodes, in properties that were used for short-term accommodation. So really interesting. It's not endemic across the property marketplace. And if you have a look, Andy, Perth, check this out. Perth, this is a leading indicator for me, and we've always seen this. I've talked about this for a couple of weeks now. Perth, extremely low vacancy rate. Perth, the second highest average income in Australia. Perth, the lowest average house price in Australia. And I'm not telling people to buy right now, because I don't think it's a time to buy right now, but Perth's one to watch, and it hasn't done anything for 11 years. And mining, iron ore prices highest in 8 or 10 years, Andy. You might be able to tell me that one as we go along.
Years, but it's up.
Yep. It's up. The prices are up. But for me, we have a look at this. These are indicators. They're not absolutes. And we have a look at Adelaide, vacancy rate down. Brisbane, vacancy rate down. Canberra, vacancy rate down. Darwin, thank God, vacancy rate down. But if you have a look at Hobart, I would never invest in Hobart or Darwin anyway myself, but Hobart, vacancy rate up, but it's up from the lowest in ever history in Hobart's life, from 0.5% to 0.7%. Not a big deal. Don't worry about it, right? So that's what's in the news for me in my world of, vacancy rates, big, good information this week when it comes to the real estate game. A couple of other things. I always like to watch the Australian Financial Review. They used to be very good. These days, they're a bit sensationalist as far as I'm concerned. I think they're getting a bit loose. But this, for the first time, I've seen a headline that's actually wasn't stupid when it came to drops in average prices. And yeah, I reckon Sydney and Melbourne could have an adjustment on average house prices between 10 and 15%. I said that a while ago. Actually, that was coming way before COVID. There was an adjustment coming before COVID. I don't think it'll be 15% personally. I still think that's a bit bullish, but I certainly think between 8 and 10%, certainly something that will be an adjustment on average house price, not every house price. And that's the thing with this average house price stuff. So really at the end of the day, the predictions are getting smaller and smaller. Where's the call of 40%, 50% drops? Harry Dent, the dipshit Dent, he's disappeared, hasn't he? Anyway, that guy is a turkey. Don't listen to him.
Doomsday will come back. Doomsday Dent will come back. Don't worry.
Doomsday Dent will come back. Exactly. Another one, homeowners that are selling right now. And, there's not a lot of, there's no panic selling in the market right now, by and large. And I don't think there will be into the future. We talked about this last week, Andy, about the Australian government not wanting or needing that in the banking system and in the housing system. I still think they will facilitate a soft landing for this, because COVID was no one's fault, right? That's what we know. The GFC, completely different. You're an idiot. You over leveraged, your problem, your fault. We don't care. We're ripping the Band-Aid off. This one, the government and the banks will engineer as soft a landing as possible for every person with debt in this country, and we're already seeing that. But what homeowners are triggering for selling now is they're looking for more space. And that's an interesting conversation in itself when it comes to the changing of people and their needs at home. I think I said it the other day that we've handed in our leases in a number of locations in Australia. We're not going back to offices at Positive ever again. And now I'm offering to my guys, my team, I'm offering some allowances to either move, and I will pay them a weekly amount to cover them moving to another property so they can have a spare room to work from at home. And also I'm giving them one-off fees to set up their own home office in a really special way. So I think a bit of that's going to happen. And I think there's some interesting things going to happen in the property market. But this one, dun, 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 the thing that I've been saying for over 9 months, now it's for real. Now the Financial Review has actually reported it. It's for real. Wait a minute. The supply is going to dry up over the next 3 years. Yeah. Well, you didn't have to wait all this time for the Financial Review to tell you. Myself and Sam and our team have been saying this for over 9 months. The approvals of property and property for construction in Australia is at all-time lows and was heading to all-time lows even before COVID. And right now, our supply chain of construction to real estate is in all sorts of challenges and problems and troubles. And that, for me as a property investor, is going to underwrite, call it a soft landing, call it a hard ceiling, call it a whatever floor, whatever you want to call it, because I have put my rents up in my Brisbane property last week, $50. In the middle of COVID, in the middle of a pandemic, I put my rents up. Our vacancy rate in Melbourne in our property management portfolio, we have just over 350 properties. We have one property, our arrears rate, we have 2 properties in arrears in their rents in Melbourne. All right. It's not a disaster, gang. It's focused in certain areas, vacancy and arrears in certain styles of property. But anyway, I think that's about it from me in the news, Andy, for the property world. A bit out there, but nothing that we weren't already talking about for many months prior to this. The takeaway for me is, if you understand where to grab your data and information from far earlier in the piece, waiting until someone at a newspaper reports it to you, you can be well ahead of the game. But anyway, there you go. That's it from me in the news. Andy, what do you got, mate, at your end of town?
Well, mate, I've got something which is, do I bring it up now? Otherwise, we're going to get distracted. No, I'll leave this one to the end because it actually dovetails into some of the stuff that you were talking about banks and all of that sort of jazz. So it's a really interesting tidbit, but I'll leave that one until the end. I'll reiterate just now that, gang, if you've got any questions, start firing them through. We're going to start to address these earlier on in the session. So if there's a burning question out there, fire it through. If there's a silly question out there, fire it through. This is some sort of weird carrot juice, and thank you for all of your support and kind words down here that I'm not sharing a wine tonight. It's
I've got a comment here from Graham. If Graham's still on, I don't know if it was a tongue in cheek or he's having a shot, but he's saying, you guys are having wine and wisdom and I'm at the beer and bullshit stage today. So I love it.
Welcome on the journey.
Awesome.
In the news, it's constantly interesting what's actually happening around here. For those social media fans, and most of you are on here are knowing about it. Some of you will have already heard about this, but it's becoming really interesting now. They've got so TikTok, which is one of the new social platforms. I think we've even talked about this on a Wine and Wisdom before.
Yeah.
TikTok are probably one of the biggest competitors or potential competitors to Facebook out there. And apparently Mark Zuckerberg brought it up to Mr. Trump at a private dinner about the data security of having a Chinese company owning this technology. So in very pragmatic, measured form, using a lot of data analytics, the way that Trump seems to run America, he almost immediately went out after that dinner and said, we're going to ban Facebook in America, TikTok in America. Unless, and cop this for a clincher, unless you sell it to an American company. So talk about trade war, that's an extraordinary reach. Now, this has been around for a little while, but one of the front runners in there is Microsoft. which is
Yeah,
interesting. Right. But now the US government are being sued by TikTok, which is I'm wondering how many videos are going to be shared on the impeachment hearings that'll come from it, or the legal case. I just thought it was hilarious, but it's an interesting one to watch because TikTok really is one of the big firers as far as taking social distribution. And if so, Microsoft's share price rose quite dramatically when this was announced. And if a merger like this or an acquisition like this does actually take place from we won't call them second tier tech companies because they're all top tier, right? But somebody who wants to break into that social race and give TikTok a run, give Facebook a run for its money. Geez, even I'm saying TikTok first. Perhaps we should be going live on TikTok. So, mate, that's an interesting one, and I've never ever seen in my life, I don't think, where a government has basically banned a company unless it was sold. It's extortion, really.
Well, if it was going to happen, it'd be a Trump, wouldn't it? That's a Trump move, right? So, anyway. But what's happening in Australia, like, Andy, in that vein, right now, YouTube and Google are having a little bit of a spat with the Australian government in and around that sort of stuff as well, right? So, I see it popping up in my feed, in my YouTube feed, and whatever it is. So it's kind of floating around, isn't it? There's a bit of a theme.
But there certainly is. But an American economy taking on one of the companies that operate in it, who want to penetrate that market, probably have a little bit more sway than what the Australian market does to Google, because I'm pretty sure that Google's balance sheet could still pay out our national debt.
Yeah, it probably could. Yeah, you did right.
So if push comes to shove, Google to buy Australia, at least then we'd have some good governance. Ooh, did he go there? Yes, he did.
Did we go there? I mean, this is an interesting thing, isn't it? Some corporations now around the world are bigger than I think you said it last time. Last one in wisdom, bigger than full countries. GDP. Like unbelievable. It's the Blade Runner or the what's the other one? The one you talk about all the time. The
Fifth Element.
The Fifth Element. I was going to say Sixth Sense, but yeah, Fifth Element. I love that movie too. Like, that's the future, But anyway, we're getting off track, Andy. What else is in the news?
They're on their way. That's a good segue into this. So what do you do with a company when it starts to get beyond the reach of your average person being able to invest in it? Well, quite simply, you do this. And this is not just known as a pizza. This is actually known as a share split, or it's a graphical representation of a share split. Now, two major tech companies, the first one is Apple, have actually split their stocks, and so have Tesla. So what is it? What is a stock split? Well, effectively, before the stock split, we've got Apple currently at around about $500 US. So that's about $668, maybe $700 worth of stock in Australian dollars terms. So each stock is actually quite a large value, right? So what they're intending to do with their stock split is actually divide that by 4. So they're literally going to slice it up into the 4 different parts of the pie. What does that mean? It actually just means that the fractured ownership of the company is just divided by 4. So if you owned 4 shares at $100 and they split it by 4, you would own them at $25. Right? Geez, I'm glad I got that part of math right. It would have been pretty awkward if I'd screwed that one up, wouldn't it?
Mate, I tell you.
So a little bit of a nice anecdote on this is that the Wolf of Wall Street used this strategy of stock splitting once upon a time to actually make, or the reverse of stock splitting, right, to make micro stocks look more plausible. So when you went to sell a stock that was, a penny stock worth cents, and you went to a serious, share trader, they'd look at it and they go, 50-cent stock. Look, I think we'll wait. So what he did is he did the reverse, and he said, let's take more shares off the market and increase the value of the underlying shares. They look like a medium cap stock, and then we'll just talk it up around the story. So gave a lot of bullshit to it. And as a result, that's how he rose to crime, or whatever it was. It was a crime, allegedly, I assume it was. So that's so there's one with with Apple, which did it, and the other one is Tesla. And I love this headline. And I love the picture that actually accompanies it, because Tesla has been one of those stocks now. It's bigger than General Motors. We've talked about it a lot in here. And one way that, and this is my belief, so don't go out and buy Tesla, or this isn't advice, but what I believe.
I'm buying Tesla. I am, Andy.
I'm not saying that I'm not, and I haven't, but realistically, there's no rational reason to buy it. It's a bit of a gamble. And we'll chat about that a little bit later on with private to public. But the fundamentally, Tesla stock, for those people who don't know what Tesla is running at, it's currently running at $2,238 a stock. So this is far beyond the reach of your average, punter who wants to jump on the Tesla cult. And look at these two companies; they're both cult-like companies. You've got Steve Jobs, right? And now Steve has created a cult of Apple devotees, and you've got Elon Musk, right, or is over there, Elon Musk, who has done exactly the same thing with Tesla. So it gives the ability for these stocks to go far beyond their rational price points or what the actual company is worth. So here's my little glimmer of what I think is going to happen. And look, for most of you, you won't be able to go out and buy the stock before this actually happens. So, and again, I'm not telling you to buy the stock, but let's just see whether it happens. Throw it out there. I reckon that the stock will actually move rapidly in the north direction as a result of more people being able to jump on to the bandwagon of owning, even if it's just one Tesla share, just one Apple share. It's now going to come in the reach of people who previously couldn't be a part of it because it was out of their control, it was out of their reach. Now I think this has been a very, very smart move that will probably see their stock price actually climb even further into irrational zones.
Irrational words. So Andy, so just quickly for those who are listening in, and certainly, for me, I'm certainly not, experienced or, in any way, shape or form in the world of the stock market. I love chatting with you. That's why I really enjoy these Fridays and other times we have a chat. But, what's the rationale behind the stock split? I mean, in my head, I'm thinking, all right, everybody used to see a Tesla stock at, I don't know, $2,000. Now it's at $500. Everyone piles in, but the ceiling, like really the psychological ceiling is still $2,000. So people keep buying because they used to see a stock at 2,000. Is that kind of like, is that what happens? Is that the rationale?
I'm pretty sure I'm pretty sure the answer to this question is going to come as the answer to the private and public sector. So maybe we'll put a to be continued
in that one
because I don't want to spoil it too early. But it's a great question, and it comes down to how do you value things? And how do you value it? My little tip, and as I said, it's not don't go out and buy the stock, but my little tip is that I reckon we'll see a good little rally, and it may only be for a week. That's why I'm saying it may, but you might get a 20% kick in a week because of the share split and people jumping in because they can, and that'll be just one that's interesting to watch. And then finally, mate, the one that is well and truly in your world is one of the most extraordinary comments that I saw come out, and it was not in this article. But and let me make sure that I don't misquote it. So the NAB boss, Ross McEwen, warned there will be some circumstances where people are better off selling out early and taking some equity out of their homes or keeping some equity before it disappears. I've never actually heard a CEO come out and give financial advice to the masses before, and this was a trade update, so it was for participants in the stock. But mate, that's a pretty heavy hand that he's brought out there, and it leads to some interesting questions about what the bank's views are on property, what they could possibly gain from this. Because I'm going to be the cynical one and go, probably not much comes out of their mouth unless they've got something to gain from it. So, mate, this is really your game, but the bank's coming in and putting a comment like that out there. I understand the rationale behind it, which is if you're 80 or 90% leveraged in your principal place of residence, you're struggling to pay the rent right now. If there's a chance that your area of property could go down, then there's a chance that you actually owe the bank money after you sell the house. Like that, that's effectively what he's saying.
Yeah.
But should he be saying it?
Well, and this is the thing, and it sort of comes over to my neck of the woods, but it comes back to your neck of the woods, which is, if the bank is carrying a loan that is upside down in value and equity, right? The asset it's secured against is upside down in its security. The bank then obviously has to declare that they're a public company. They have to declare, the assets in a certain way. They're regulated, and they have to tell the marketplace. And then I would expect the marketplace would react pretty poorly to NAB's, upside down loan reporting. And I don't know exactly the way they would report it, but they'd have to report that, and that would certainly have an effect in their share price. So what he's probably saying right now, very self-interested comment, is, hey, listen, why don't you sell it for a profit before you go upside down in equity, so then we don't have to report your loan is upside down in equity or you're in arrears, because that will affect my share price. That's what he's probably saying. At the end of the day, whether those funds are lent to that person or someone else, they're not going to necessarily benefit any differently. There's no limit. They don't need funds back to then lend to others. Like, there's nothing going on like that in the banking system. So 100%, I would say it'd reflect badly on their share price, because their book, is not AAA rated anymore. It's, A- or whatever it is, and that affects their share price. So, but I would say 100% self-interested commentary around their share price, and how they report on, the value of their loan book to asset ratio.
Well, I thought it was interesting timing. Also, given that these loan reliefs are going to start to come off offline or online, whichever you want to call it, you're going to have to start paying these loans back again. And it's probably not a bad idea to scare the shit out of a few people so that they can equalise their balance sheet. But outrageous commentary from the CEO of the NAB, and so it's in the public domain. I was astounded when I read that.
Well, it's pretty loose commentary, It's like, you should sell your properties, And this is an interesting thing. This is what I'm. And it sort of plays into sort of the wealth psychology, and I've sort of chatted about this a few times with my crew. Who are we socialized to trust in our economic world of influence? Who would be the high trust, and then reducing it down? Well, by and large, the guy from the bank would be very high on the trust and advice scale by default, not by quality of experience or capacity or qualification or whatever. It's just works for the bank. They must know what they're talking about. The other one that is like a real sort of immediate default trust is your accountant. My accountant said so, and at the risk of offending a few accountants who might listen in or not, most accountants never create any significant wealth for themselves. They're mouthpieces for the ATO. They're not wealth creators. The bank guy, he works for the bank, not you. But we give away this power, Andy, without question. In that space, there's other places we do that where, we give away power to a police officer or a teacher or a nurse or a doctor, or like those are default positions, in different places. But in our financial world, what is that default position? If I said to you, what do you reckon? Get a real estate agent, a banker, an accountant, and measure them in trustworthiness or whatever, you'd go, real estate agent should be down here, and the banker would be up there and the accountant in here. And, it's an interesting process to go through, But
it was funny, wasn't it? When I don't know, and some of you who are here listening today, Sam, Vivian, Shelley, good to have you on board. Might have remembered when we first started doing this, and we had Paul Sidorovsky on here, and we had a few other guests, which we'll bring back again soon. And each time we introduced one of them, I think I was one who put my foot in. I've gone, as accountants, you've got a bit of a dubious track record. And then I realised, well, hang on, I'm an advisor. You're in the real estate game. We're all bloody tainted with the bad brush, aren't we?
Yeah, the trinity of trouble.
And
yeah.
the trinity of trouble. It's like, let's run to the bank manager. They're the person of most least ill repute. And but it is really interesting, isn't it? Because it goes to commoditization or necessity. It's like or then just basic fundamental blind faith a lot of the time is who my brother uses.
Yeah.
Or we just go to the banks because we don't know who to trust. And that is the biggest oxymoron you could ever come up with.
Mate, totally, mate. Yeah. The head of a bank sort of giving, literally telling the general public, hey, sell your properties before you get into trouble, because, which is no better than, the mad media, fear mongering, misinformation and stupidity, at the end of the day. So, it's an interesting one. It's self-interested. It's a self-interested comment. You're spot on. He's only saying it because he's probably on the hook for the value of his share price, and he knows if he's got some loans that might go upside down, his share price will go down, and he might lose his friggin' bonus. That's the motivation of the commentary every day of the week. Mate. Yeah, good pickup in the media, mate, because it's interesting times, as we've said 1,000 times in the world of COVID and those sorts of things. But mate, interesting market time out there right now. What's going on from last week, mate? We sort of had a bit of a chat about a couple of concepts. You were mentioning Tesla there before, and folks, I was sort of chatting to Andy just before we got online about me being very excited about Tesla. I've been researching to do a bit of solar in and around my property here, and quite keen to get that going. But one of the interesting things, I was watching a bit of a documentary about Tesla's bigger plans about using some of its products, cars, power walls, all sorts of things to become, storage systems for electricity and selling that electricity back to the grid in really smart ways, around the world. And, to make the commentary a little bit sort of compressed into one space, Tesla is selling Tesla cars, and it's like Andy said, it's bigger than General Motors now. I mean, it's producing a lot of cars, and it's only going to speed up. And those cars carry batteries, and those batteries, by and large, aren't used all the time. And so Tesla's plan is to, have those batteries connected via a special set of software in the grid all over the world to be able to store sunlight in your car battery that's in your garage, and they're charging it, with a solar panel from somewhere else. It's an amazing concept. And that, for me, that's part of the dream, Andy, where it's like, I don't really care about, Tesla's, cash flow. I'm a believer in the dream. I'm buying in. I'll give them some money. Take my money. Give me some shares, Tesla, And, it brings up the conversation we sort of posed last time we were having a chat, Andy, about the idea of private to public value in the world of the stock market, right? And for those who are listening in, if you own a business, or you were to value a private business, if you were to go down the road and value a cafe, or you were to value, I don't know, like let's say a grocery store, or an accounting business, or a gym, or whatever it is, by and large, the private a private valuation on a business is based on its ability to earn a net income, which is a profit often, Andy, 9 times out of 10. Put some profit in my pocket. I'll pay you a multiple for that profit in my pocket as the business owner, 1 times, 2 times the profit. And that's its valuation. So, but in the world of going from private valuations to public valuations, you know, companies like Amazon and, you know, and even Tesla, you know, make losses, but their prices go up and their multiple, you know, is insane, 10, 20, 50 times, sometimes 100 times. So I'm really curious with your, you know, with your background, you know, some commentary around that sort of stuff, private to public arbitrage, you know, and, you know, what does it look like? You know, how does it justify, or it's not justifiable, it's just how it works?
Would it be terrible if I told you that the answer is extraordinarily simple?
No, it wouldn't be. It wouldn't be terrible. It'd be good.
The complexity comes. The answer is very simple, but the complexity behind the answer is extreme, and it's different every single time. Quite simply, the value of a business, in my opinion, is worth whatever somebody's willing to pay for it. Bottom line.
Yeah.
And might sound really simple, but let's have a look at Tesla and let's have a look at, you know, Apple. Fundamentally, are there, because what you said about how we sell small to medium businesses is it's a function of what is the forward-looking cash flow of that business, or what is the forward-looking growth of their distribution, right? And distribution usually ends up is cash flow, forward-looking cash flow. So the price that people pay in the stock market is meant to be representative of the future cash flows of the business. That's what it's meant to be. And that's how brokers around the world, that's how most people look at it. And then when the comment of, oh gosh, I always forget him because I only quote him when I'm talking about things like this. Warren Buffett, that's it. He talks about the market can stay irrational longer than you can stay solvent, right? Because if you keep waiting, and the market can be very, very irrational, because in the public market or in the stock market, it's driven largely by emotion. It's driven by investor sentiment. And so if you have a look at Tesla and you go, what is Tesla worth? It put out 50,000 cars last quarter. Okay, that's not worth its current market cap, not by an absolute long shot, right?
Compared
so
to
why are people paying
like 1 million cars or something, Andy? Like, what's the comparison? Do you know?
Oh, we're talking General Motors, Daimler. I don't know how many cars they pumped out last year, but you'd whack a couple of zeros on the end of that.
Yes. Yeah.
So what you brought up with Tesla, though, is really interesting, because Tesla's well beyond, like maybe 100 times what its valuation really should be based on what it's doing now. But if you then go, okay, well, let's take that as the perception of the public. If you take the perception that Tesla is going to have a car in every household in the United States of America, which is going to feed money back into the grid. So let's just say that the population of America is 338 million people. Let's just divide it by 4 to say that's how many households that there are. So that's 82 million that's sitting there now. If we say 82 million of the, and in the future, 82 million is going to have Tesla cars. So that's a lot of cars to start with. But then all of those cars are going to be pumping money back into the grid, of which Tesla is earning money on. And let's just say that it's only $1,000 a year. And we know that it's going to be a lot more than that based on energy costs. But let's just say that it's $1,000 a year. That's $82 billion. So now you go, apart from the car business, there's an $82 billion future cash flow of that business.
Yeah.
And that's why I mean that businesses, companies are ultimately what people are willing to pay for it based on their belief of what the future cash flows of that business are. The challenge in our world is, and we've got a number of acquisitions and sales that are happening at the moment with clients and related clients of mine. The hard part is the general market, so the stock market, is a little bit more transparent. Right? There's news going around. You kind of understand what people's play is. So you know that Microsoft is interested in buying TikTok. You know it. And you don't know what price, right? But then people can start to work out distribution for Microsoft, because, okay, well, what's Microsoft going to use TikTok for? It's going to use it as a social platform. So Microsoft's infrastructure, TikTok as a distribution platform, they can do the algorithms and start to figure out what that looks like in the future. And it's going to be nowhere near right, right? But it's a formula that they're going to use in order to be able to figure out ballpark. And the challenge in the small to medium world is that, let's just say that I want to buy your business, or vice versa, or Jace, you want to buy my business. You come in and I might have you're the only buyer, or maybe there might be a few other people around there that want to buy my business, but effectively at the moment, you're the front runner. Now, I've got a lot of attachment to my business, so I believe it's worth something. And quite often in our world, what we believe our business is worth, it's worth nowhere near that.
No.
And then somebody like you will come in and you go, I'll give you 3 times EBIT, Andy. And I go, well, I may as well just keep working for the next 3 years. And then, but I don't know what your game is. And so this is the hardest part in the small to medium world, is to go, well, what is it that this person could potentially downstream value add, or what are they willing to pay? Because you might be able to take my business and the infrastructure of my business and blow it up to 20 times. So you might offer me 5 times EBIT, but you might be willing to pay 150 just for the ease of getting something that's set up right now. And the gap, right, between 5 and 150 is huge. And it's exactly the same thing that happens in the stock market as well. It's just less price transparency. And as a small to medium business owner, it's just so difficult. And here's the thing, do not get a valuation from your accountant and think that that's what the valuation of your business is.
Wow, mate, we're on the same page there with that sort of thing. Like, you know, I hear that in the property world as well. Oh, my accountant did the depreciation schedule. I'm like, what? Are you kidding me? Get a professional depreciation schedule done by a depreciation expert, not a friggin' accountant. Dead right, the same thing, man. Yeah.
Yeah, you need to know what the accounting value is, because you need to know what your assets are. And you need to know roughly forward multiples of the business, what that means. But here's the thing, is that quite often the accountants don't give all the add backs, right? Because if you come and buy my business, well, all of a sudden you don't have me, right? Or maybe you want me, you probably would, right? So then you have to pay
extra for you, Andy. I'd pay extra for you.
But you're not going to pay for my, thank you. That just doubled the price of the business, by the way. And so, but you don't have to pay for my car. You don't have to pay for my electricity. You probably don't want my office. You know, all of these things, when you get other people to value your business, they don't add these back in the appropriate way. So you need to know structurally what your business is worth, kind of like how much is a human worth? Apparently we're worth $5.20 or something in the byproduct of our body. We need to know that of our business, but that valuation is fundamentally about as the same as me saying, Jason, you're worth $5.23 because that's the composition of your body and minerals and water. And so that's why the answer is super, super simple. It's what people are willing to pay for it. How you derive that is hyper complex.
Yeah. No, that's a good way. That's a good way of spinning the question, very much like a politician, Andy.
Well,
no, but it's good. I mean,
I'll take off the veil for you. I'll take off the veil. So if you're going to sell your business, the best thing that you can do is you can start to analyze the people. Know the people who you know, the audience who want to acquire your business. Yes. Understand what the downstream value add is that they can do with your business instantaneously. Let's face it, there's a reason why it's taken you 10 years or 15 years to get to a stage where you can sell your business. And that's because it's not easy to start up straight away. So there is an intrinsic value, there is a time value of a business that is already established. Because that means that people don't have to go through the bumps and scrapes and the multiple fights and make all of the fuck ups that we have. Like the amount of things that we've fucked up is one of the most incredibly valuable things that is the byproduct in our business. Yeah. And that's why quite often they want to take you with the business. So the best bit of advice I can give in our small to medium business game is to understand what the downstream value add capabilities, probabilities, and possibilities are for the people who are acquiring your business. And that means you need to know what they do. You need to ask incredibly good questions. You need to do background research. You ask for references of the people that you're selling your business to. And you've got to start to figure out what their capacity is and go, you know what? Okay, the fixed value of my business is $3 million. It's taken me 10 years to get here, and the IP in this business is probably worth $1 million by itself. Because can anybody else create this? And does anybody else have this? Well, they might have it, but it's in a different company. So you have to put some tangible value around that. And then if you want to get to their price, as close as you possibly can to their price, you need to be able to understand how they can take your business and create great opportunity from it. And that will get you closer to what you should sell the business, but you'll never get it smack on the money.
It's a good one. It's a good one. Any of the business owners listening in, you know, some of the IP and systems you create will add massive value to those who potentially would buy it in the future, because they don't have to replicate those. And if those systems and IP are can be shown to be consistent to repeat an outcome, which is an income outcome, then they then continue to, you know, attract a much higher multiple. So yeah. No, I love that. I love that stuff. You know, for those, no, for those who got to do it. You know,
And we've got a bit of a delay and a lag, but it's about people and process. Because first thing, yes, your people are worth a lot in your business if you've got good people, but as much as if you've got incredible processes in place and automations in place where it's a plug and play, then the value of your business goes up exponentially. Because then it's a matter, if you've got a sausage factory here, well, and you've got a meat company here, well, it's just a matter of feeding it into the machine. And that to a massive meat company is worth probably 100 times more than what it would be for a small sausage manufacturer, as a really terrible example. It's probably because I need to eat some meat right now.
I was just surprised that I didn't know where the meat and the sausage came from then, Andy. Like I just, but anyway, that's...
Tomorrow's dinner, Jace, tomorrow's dinner. It's coming.
Well, you know, mate, that's a good analogy anyway for those business owners that are listening in or dialed in with us tonight. You know, think about that as an exit strategy. Like everybody, no matter whether you're an investor or a business owner, the concept of an exit strategy, thinking about, all right, well, one day I don't want to do this as my everyday thing to generate income, exchange time for money, or whatever it is. What value, what asset am I building? What value or asset am I exchanging time for money and creating into the future? Which is that thing. I did a video ages ago, which was, you know, how do you qualify and quantify your value, your personal value? And a lot of people quantify and quantify their personal value in the time exchange valuation. So Andy, you know, my time is worth $100 an hour. My time is worth $200 an hour, $300 an hour. So we get caught in this like locked mindset of time for money exchange. And, you know, it's actually a flawed strategy. It's a flawed process long term, because it's kind of one dimension to the exchange. One dimension is if I exchange something, which might be time or IP or effort, I get some money. Now, with that money, if I get a net result of that money, I might get $1 and 50% of it goes to my living expense or the cost of my living, but 50% of it, 50 cents of it can be deployed into something else. That in my world becomes really interesting. Like if you might exchange time for money, but then what do you exchange the money for afterward? Do you exchange money for something that devalues, or do you exchange money for then something that increases in value, that can circle around and replace your need to exchange your time and effort for money if you took you or me out of the equation, what's going to produce the income, right? And that's really the gist of, your and my world for all of our clients and our customers is, if you were not in the equation as the human exchange, the effort exchange, the money, the time for money, the effort for money, the IP for money, the mental exchange for money, well, then how do you get the return? Like, how do you quantify that? What are you doing? And that's where we sort of come in and we talk about this stuff about getting assets, shares, businesses, properties into the future that work when you don't want to, or you don't have to. That's really the conversation. And valuing that is really super important in both ways, valuing it from a emotional, mental point of view, but also valuing it from a practical, dollars and cents point of view. As we go along, I've seen you do that, do the life cycle of people through their ages, as they get a bit older, their capacity for value exchange, time value exchange in the marketplace actually decreases. You're 55, 60, you're up against a young executive, maybe, 40 to 45, a lot of people would see the younger person having more value exchange from an energy point of view, time and effort point of view, compared to someone who's a bit older. Like, there's this kind of inverse, bell curve in that sort of space. So, good conversations to have, mate. That's for sure.
Mate, I like it. I've never thought about it from that perspective before, but given the fact that we're talking about Tesla and batteries, it's a really, I think you've created a great analogy there. But it's a matter of, yes, we're deploying energy into our occupation, whether it's salaried employee or whether it's a business owner.
Yep.
If it's a business owner, your exit game is you storing some of that energy for a point down the track where you can redeploy it. And if you're not doing that, then you need to be storing some of that energy into property, into investing, because eventually you will not be able to run your business anymore. And if you're not structuring it for sale, to store that energy for sale, you need to store some of that energy somewhere else where it's going to be able to provide for you later. And ultimately, if you're an employee within a business, you've got that energy that you're deploying and you receive energy back. And it's a matter of going, well, do I just put it into today and every last bit goes into the moment? And that's fine if that's the way you want to live, but there will be a day where it will not be there. And so you've got two options. You either start a side hustle or look at business, and you start a side hustle in order to be able to put more energy and store more energy for the future. So I guess the analogy there is, or the question is, for your future, what energy are you storing?
Mate, it's a good question, mate, and probably a perfect way to finalise the evening on the hour, which has been awesome to chat to you. I couldn't hear it, Andy. You might have to share it and do the thing again. But I think that's perfect, because at the end of the day, really, both you and my world live in this space. What resources, what energy are you storing for the future, and what will that produce? A renewable source, right? So, and I actually really like that analogy. I love the way you think, Andy. Like a renewables, a depletion energy system or a renewable energy system, which is got a positive return curve or a negative return curve. Because you see, you've seen it, I've seen it. I've seen people saying, right, I've got 200 grand in my super, I've retired and, I've got 4 years and then it'll be all gone. That's a kind of like they stored it, but it wasn't a self-perpetuating positive return system. It was a negative return system. And now they just deplete it till zero and then, that's it, I'm done. Or if we build a positive return system where you can store that energy, but it's actually replicating at a far greater rate than its requirement for expenses, then that is exactly what it's all about. I like that, mate. I like that. That's so clever.
Who said we weren't in renewable energy? Right? This is we're green energy right here. It's all about green energy.
We are green energy, mate. Green energy investing, not what you think. This is where we're going. I love it, mate. I love it. That's perfect, mate. That's awesome, mate. It's been really good to chat with you tonight, buddy. Awesome. There's been a fair few people online tonight, but they've stuck with us the whole time, which is awesome. So great to have you guys on. Lee, Rod, Damien, Emily, Jace, Jono, Christopher, Graham. I hope you're still there, mate. You asked us that good beer and bullshit question earlier in the night, which was hilarious, which was awesome. But hey, listen, gang, great to connect and see you guys again. Thanks for another wine and wisdom, Andy. I've done my wine and I've maxed on my wisdom, I think. Yeah, well, there you go. Juice for you. We'll see how that works out.
yeah. I'll tell you tomorrow after my coffee.
That's it. Anyway, all right, buddy. Well, great to chat with you, mate. Thanks for everyone dialing in tonight. Fantastic to have you guys online, and hopefully we added some value. And I didn't get a chance to talk about the banking and finance system, but I want to put a pin in that one for next week, the evolution of the bank. And I don't know, I'm going to drop this one over the fence, Andy. Did you know that the Commonwealth Bank actually was our Reserve Bank of Australia right back in the early days of banking, and it split? The Reserve Bank of Australia actually was created from the Commonwealth Bank, and the Commonwealth Bank turned into a regular, everyday savings and loans bank. Anyway, we'll talk about that next week. I think after our what's in the news, I think that would be kind of cool to talk about the banking system, the fractional lending process, and I threatened to talk about that last week, but we didn't get a chance this week. But we had some great conversation to have. But dial in next week, gang. We're going to talk about fractional lending and the banking system. Might curl your toes, but it is what it is. And if you use it to your advantage, then in a safe way, you'll be all good. But all right, mate, that's it from us. Thanks, everybody. Take care. Have a great weekend. Thanks for joining us on a Friday evening, and have a great one. And we'll catch you next week, gang. All right, take care. Thanks, Andy.
See you, mate.
All right. Bye-bye.